In April 2024, General Electric did something it had threatened for years. It broke itself apart. The power business was spun off as a separate company called GE Vernova. 2 years later, that spin-off is worth about $260 billion. Why? Because it sells the one thing the AI boom is most starved for: power generation. It sits on a backlog of $163 billion, and it's one of only 3 companies on Earth that can build a heavy-duty gas turbine. Its machines already generate about a quarter of the world's electricity, and yet it trades at roughly 52 times forward earnings. So is GE Vernova the purest way to own the power side of the AI trade? Or a spin-off that's already run too far? Let's run the numbers. Start with the order book, because it's staggering. In the first quarter of 2026, GE Vernova's orders rose 71% organically to $18.3 billion in a single quarter. Its total backlog jumped past $163 billion. And the company now expects to hit $200 billion in backlog by 2027, a full year ahead of its old target. For the full year 2025, revenue was $38 billion, up 9%, and free cash flow was $3.7 billion, more than double the year before. Hold on to that free cash flow number, because with this company, the headline profit figure will lie to you, and the cash flow is where the truth is. So, what's actually inside GE Vernova? 3 businesses, and they could not be more different. First, power, gas, nuclear, hydro, steam turbines. This is the crown jewel. Steady mid-single-digit growth, double-digit margins, and the gas turbine franchise everyone wants. Second, electrification. The grid equipment, transformers, switchgear, grid software. This is the fastest grower, expanding around 25% a year. Third, wind, onshore and offshore turbines. And this one is the problem child. It's still losing money, around $400 million a year. So the story is 2 engines pulling hard, power and grid, and 1 anchor dragging behind. The whole investment case is whether the engines keep winning faster than the anchor weighs. Now the heart of it, the gas turbine business. Only 3 companies on Earth build heavy-duty gas turbines at scale: GE Vernova, Siemens Energy, and Mitsubishi. Together they control over 70% of capacity. GE Vernova leads. Its installed fleet already generates about 25% of the world's electricity. And here's what makes it a seller's market. There is not enough capacity to go around. More than $400 billion of planned gas power plants are at risk. Not because of demand, but because there aren't enough factories to build the turbines. The wait list now stretches into 2029. When the world is desperate for power and only 3 firms can supply the machines, they don't compete on price. They book years of work and raise it. GE Vernova's gas backlog and reservations just jumped from 83 to 100 gigawatts in a single quarter. Now the fastest growing piece, and it's pure AI. GE Vernova's electrification segment makes the grid equipment that connects power to demand. In the first quarter of 2026, its orders rose 86%. Data center orders alone were about $2.4 billion. In 1 quarter, that's more than the company booked in all of 2025. Step back and the scale of the shift is clear. This segment's backlog has gone from $9 billion in 2022 to $42 billion today. Every gigawatt of AI data center needs transformers, switchgear, and grid connection, and GE Vernova sells all of it. This is the power side of the AI build-out: the chips, the cooling, the electrical backbone, and now the generation and the grid. Next in this series, we follow the fuel itself, uranium, and the company that mines it, Cameco. Subscribe. Now, the most important slide for anyone valuing this company. Look at the headline net income and you'll be fooled. In the first quarter, GE Vernova reported $4.7 billion of net income, a 51% margin that would be absurd for an industrial. But almost all of it came from one-time gains, about $4.5 billion of accounting gains on deals. The full year 2025 profit was flattered the same way by a near $3 billion tax benefit. So ignore the GAAP profit line. The real measure of this business is free cash flow, $3.7 billion last year, guided to between $6.5 and $7.5 billion this year. That near doubling of cash, not the noisy net income, is the number that tells you the engine is actually accelerating. So what protects this position? Why can't a new rival just show up? First, the installed base. GE Vernova's turbines already generate a quarter of the planet's electricity, and every one of those machines needs decades of parts and service. That aftermarket is a high-margin annuity that compounds for 30 years. Second, capacity scarcity. You cannot build a gas turbine factory overnight. It takes years and billions, and the certification to build machines this critical takes longer still. Third, the switching cost. A utility betting a multi-billion-dollar power plant on a turbine does not gamble on an unproven supplier. Installed base, plus scarcity, plus trust. That's why 3 companies have held this market for decades. And why the AI power crunch lands straight in their order books. So who exactly is in the field? Here's the power equipment landscape. In gas turbines, the big 3, GE Vernova the leader, then Siemens Energy of Germany and Mitsubishi of Japan. Around them, Baker Hughes and Rolls-Royce in turbines and energy tech, and the state-backed Chinese makers Dongfang and Harbin, pushing to expand abroad. The top 5 power equipment players controlled roughly 46% of the market in 2025. But in the heavy-duty gas turbines, the AI boom needs most. It's really a 3-way game, and GE Vernova is on top. It also carries the widest spread: gas, nuclear, hydro, steam, grid, and wind. No competitor matches that full energy reach. So, where's the catch? 2 of them. First, wind. Inside this otherwise excellent company sits a segment losing around $400 million a year, dragged down by offshore wind. Management is shrinking and fixing it. But until wind stops bleeding, it caps the margins of the whole company. Second, the price. GE Vernova trades at about 52 times forward earnings, on a roughly $260 billion company near $967 a share. That is priced for the power supercycle to run for years without a stumble. Wall Street is still positive. The average analyst target is around $1,200. But at this multiple, the easy money has already been made. There's also a free option on top: nuclear small modular reactors, the BWRX 300. Which could add a whole new growth leg if the nuclear revival is real. Let's put it together. On one side, one of 3 companies that build the turbines the world is desperate for, a backlog of $163 billion heading for $200, grid orders up 86%, free cash flow nearly doubling, an installed base powering a quarter of Earth's electricity, and a nuclear option on top. On the other side, a money-losing wind business, a profit line distorted by one-time gains, and a 52 times multiple that already prices in a long, smooth supercycle. The stock near $967, about a $260 billion company. The franchise says generational. The price says, don't expect a bargain. So, where do I land? In my view, GE Vernova is the closest thing to a pure bet on the physical supply of power in the AI era, and the supply shortage is real, structural, and measured in years, not quarters. The gas turbine scarcity alone is one of the best setups in the entire industrial economy. But I'd hold 2 things in mind. The valuation has already captured a lot of that optimism. At 52 times earnings, you are paying up front for execution, and the quality of earnings matters here more than almost anywhere. Watch the cash flow, not the headline profit, because the gap number is noisy. This is a genuinely great franchise where the debate is the price and the patience required to own it. My base case for the next 12 to 18 months: the backlog keeps climbing toward $200 billion, grid and gas orders stay strong, free cash flow inflex higher, and the stock trades on the power demand narrative and its rich multiple. Watch 4 signals. First, gas backlog and reservations, 100 gigawatts now, targeting at least 110 by year-end. Continued growth means the supercycle is still building. A stall is the first warning. Second, electrification orders, up 86%. This is the AI-levered engine. Watch it hold. Third, wind, a $400 million annual loss today. Turning it toward break-even is the clearest margin catalyst. Deeper losses are the drag. Fourth, free cash flow against the $6.5 to $7.5 billion guide. That, not net income, is the real proof. Upstream, GE Vernova depends on castings and specialized materials. Downstream, it sits inside every utility and data center that needs power. The catalyst that lifts it, the power supercycle running for years. The one that breaks it, a demand pause meeting a 52 times multiple. GE Vernova is the power company that fell out of GE at exactly the right moment. It's one of 3 firms that build the turbines the world can't get enough of. It sits on a $163 billion backlog heading for 200, and its machines already generate 1/4 of the planet's electricity. The catch is a money-losing wind arm, a profit line you have to read carefully, and a 52 times multiple that prices in years of success. The bull case is the power shortage of a generation. The bear case is the price you pay for it. One stock, all the numbers, no hype. I'm Big Z. Follow me. See you in the next deep dive.